Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourself, Banking and General Knowledge, etc. Today I will discuss some potential overseas posting examination questions and the corresponding sample answers for banks. Today marks part 19 of my Path Through the Corner of a series for overseas posting examination questions and the corresponding sample answers for bankers. An AD bank sanctions a foreign currency loan to an NRI depositor's resident friend against the depositor's FCNR B deposit. The resident friend wishes to use the loan proceeds to set up a poultry farm. Is this permissible and why? Option A, yes, because agricultural activities are permitted for third party borrowers who are resident Indians. B, no, because loans to third parties must be used only for direct investment in Indian companies. C, no, because foreign currency loans cannot be used for agricultural or plantation activities. D, yes, because the purpose restriction applies only when the loan is taken by the depositor himself. The answer is option B. No, because foreign currency loans cannot be used for agricultural or plantation activities. The outstanding balance for a foreign currency loan against an FCNRB deposit must not exceed the deposit's maturity. Mr. Krishnan's deposit matures in 18 months. What is the maximum tenor of the FCL that can be sanctioned for him? Option A, 3 years, since that is the maximum permissible tenor under the scheme. B, 18 months, since the loan maturity cannot exceed the deposit maturity under any circumstances. C, 24 months, since a 6-month grace period is standard in FCL products. D, the AD bank has full discretion to fix the tenor irrespective of deposit maturity. The answer is option B, 18 months, since the loan maturity cannot exceed the deposit maturity under any circumstances. Under the foreign currency loan scheme against FCNRB deposits, which of the following statements about repayment is incorrect? Option A, the account holder's loan can be repaid by adjusting the underlying FCNRB deposit. B, the loan can be repaid through inward remittances from outside India via banking channels. C, the power of attorney holder of the depositor can execute repayment documentation on behalf of the depositor. D, the loan can be repaid out of balances held in the NRO account of the account holder. The answer is option C. The power of attorney holder of the depositor can execute repayment documentation on behalf of the depositor. Delegate of the rank of ZLCC wants to further reduce the margin on a foreign currency loan against FCNRB deposit below the standard minimum. What is the absolute floor for the margin after exercising this delegation? A, 5% of the face value of the deposit receipt. B, 12% of the face value of the deposit receipt. C, 10% of the face value of the deposit receipt. D, the margin cannot be reduced below 15% under any delegation. The answer is option C, 10% of the face value of the deposit receipt. An NRI holds an FCNRB deposit in Japanese yen (JPY) and requests a foreign currency loan against it. In which country will the bank disburse the loan? A, in JPY, since the underlying deposit is in JPY. B, in USD regardless of the currency of the FCNRB deposit. C, in the currency of the borrower's choice among USD, EUR or JPY. D, in INR, since loans against NRI deposits must be disbursed in Indian rupees. The answer is option B, in USD regardless of the currency of the FCNR deposit. Which of the following is classified as a project service under the IT and software export categories refined by RBI? A, deputation of IT professionals for programming services at customers' overseas locations. B, providing telemedicine facilities using IT software. C, customized software development for specific problems for corporate mainframe user. D, development and sale of application software packages to multiple clients. The answer is option C, customized software development for specific problems of corporate mainframe user. A software exporter approaches the bank for working capital finance. His project annual turnover is rupees 1.8 crore. According to RBI operational guidelines, how should the bank assess the permissible bank finance (PBF)? A monthly cash budget method, since it is the preferred method for all software exporters. B 20% of the project turnover, since the limit is up to rupees 2 crore. Cash budget method may be adopted if borrower prefers. C cash budget method mandatory, since the RBI mandates it for all exporters. D PBF will be 25% of project exporter, as IT sector enjoys an enhanced assessment norm. The answer is option B. 20% of project turnover, since the limit is up to rupees 2 crore. Cash budget method may be adopted if borrower prefers. Which of the following does not qualify as a document that a bank should mandatorily obtain from a software exporter for credit appraisal? A. Cash budget. B. Balance sheet. C. Statement of economics. D. Certificate of origin from the exporting country. The answer is option D. Certificate of origin from the exporting country. Which of the following risk factors is most specific to financing software units as opposed to general manufacturing units? A. Possibility of the product turning non marketable. B. High obsolescence with fixed assets depreciating rapidly. C. Need to evaluate promoters' track record. D. Market competition from similar products. The answer is option B. High obsolescence with fixed assets depreciating rapidly. The Gold Card exporter submits an application for renewal of working capital limits as per the prescribed time frame. Within how many days must the bank dispose of this renewal application? A 25 days, B 7 days, C 15 days, D 30 days. The answer is 15 days. An exporter with overdue export bills amounting to 12% of the last year's export turnover approaches for a gold card. Bank should A. Issue the gold card, since 12% is only marginally above the 10% threshold and the scheme allows case by case discretion. B. Reject the gold card as the exporter exceeds the permissible overdue export of bills limit of 10% of last 12 months export turnover. C. Issue the gold card subject to obtaining an undertaking from the exporter to reduce overdues within 3 months. D. Refer the matter to the zonal manager for a special dispensation given the marginal excess. The answer is option B. Reject the gold card as the exporter exceeds the permissible overdue export bills limit of 10% of last 12 months export turnover. A gold card holder is traveling abroad urgently and needs a foreign currency. He approaches a foreign branch of our bank. What is the maximum amount in foreign currency that can be paid to him at the foreign branch? A. USD 5,000 or equivalent. B. USD 2,000 or equivalent. C. USD 1,000 or equivalent. D. USD 500 or equivalent. The answer is option C. USD 1,000 or equivalent. A large exporter company has 8 active partners or key officials who wish to hold individual gold cards. How many gold cards can actually be issued to this exporter? A. 8, since each active key official is entitled to a card. B. 3, since only primary, secondary, and tertiary cardholders are permitted. C. 5, which is the maximum number of gold cards per exporter. D. The number is unrestricted as long as each card is in the name of an active person. The answer is option C. 5, which is the maximum number of gold cards per exporter. The gold card is initially issued for a period of 3 years at the time of automatic renewal for a further 3 years. At what level is renewal approved? Option A, head office, since it involves a long term credit commitment. B, zonal office, since the zonal manager approves all credit gold card decisions. C, regional office of RBI, since renewal requires regulatory clearance. D, branch level itself, unless there are adverse features or irregularities. The answer is option D, branch level itself, unless there are adverse features or irregularities. The ISBB publication 745 was approved by the ICC Banking Commission in April 2013. What is the nature of this publication relative to UCP 600? A. It is a mandatory amendment to UCP 600 and overrides its provisions where they conflict. B. It is an independent document that can be applied instead of UCP at the beneficiary's option. C. It is consistent with UCP 600 and should be read in conjunction with it, not in isolation. It is not an amendment. D. It is a supplementary document that applies only to letters of credit issued after April 2013. The answer is option C. It is consistent with UCP 600 and should be read in conjunction with it, but not in isolation. It is not an amendment. Under ISBP 745, who bears the risk of any ambiguity in instructions for issuing or amending a documentary credit? A. The advising bank, since it is responsible for conveying accurate terms to the beneficiary. B. The applicant, since it provides the instructions to the issuing bank. C. The issuing bank, since it is responsible for the accuracy of the credit terms. D. The beneficiary, since it must present complying documents regardless of ambiguous terms. The answer is option B. The applicant, since it provides the instructions to the issuing bank. Under ISBP 745, more than what percentage of credits were being rejected on first presentation for discrepancies which led to the formulation of ISBP? A 25%, B 35%, C 50%, D 75%. The answer is option C 50%. Under the new Overseas Direct Investment ODI framework, August 2022, the concept of joint venture, JV, and wholly owned subsidiary has been option A retained as the primary definitional framework for overseas investment, B substituted by the concept of foreign entity, C merged into the concept of Indian entity for simplification, D replaced by the concept of step down subsidiary as the fundamental investment vehicle. The answer is option B substituted by the concept of foreign entity. An Indian entity holds 8% of the paid up equity in a listed foreign company and has control over it. How is this classified under the ODI framework? A as overseas portfolio investment OPI since the holding is below 10%. B as neither ODI nor OPI, it falls in a gray area requiring RBI clarification. C as ODI since control exists regardless of the percentage being less than 10%. D as foreign direct investment since the Indian entity has a controlling stake. The answer is option C as ODI since control exists regardless of the percentage being less than 10%. What is the maximum total financial commitment as a percentage of net worth that an Indian entity can make across all foreign entities under the ODI framework? A 10% of the net worth, D 200% of net worth, C 300% of net worth, D 400% of net worth. The answer is option D 400% of net worth. Under the ODI framework of an Indian entity's account is classified as NPA and it decides to make an overseas financial commitment, it must obtain NOC from the lending bank. If the lending bank does not respond within how many days the NOC is deemed granted? Option A 30 days, option B 45 days, option C 60 days, option D 90 days. The answer is option C 60 days. An Indian resident makes ODI in a foreign entity and later wants to disinvest. What is the minimum period for which the Indian resident must have stayed invested for disinvestment before disinvestment is permissible? A 6 months from the date of making ODI, B 1 year from the date of making ODI, C 2 years from the date of making ODI, D 3 years from the date of making ODI. The answer is option B 1 year from the date of making ODI. Under ODI rules, ODI in a foreign startup can only be funded from option A external commercial browsing raised by the Indian entity, B proceeds of issue of ADRs and GDRs by the Indian entity, C internal accruals of the Indian entity group or associate companies or own funds for resident individuals, D any permissible source under the automatic route up to USD 1 billion. The answer is option B internal accruals of the Indian entity group or associate companies or own funds for resident individuals. An Indian entity restructures the balance sheet of its foreign subsidiary, which has been incurring losses for the previous 2 years. The original ODI investment was USD 12 million. The proposed diminution is 18% of total outstanding dues. Is a valuation certificate from a registered valuer required? A. No, since the diminution is below 20% of total outstanding dues. B. Yes, since the original investment exceeds USD 10 million, irrespective of the diminution percentage. C. No, since the foreign entity is incurring losses for only 2 years and this falls within the restructuring window. D. Yes, since all balance sheet restructuring involving overseas entities requires mandatory third party valuation. The answer is option B. Yes, since the original investment exceeds USD 10 million, irrespective of the diminution percentage. Pre-incorporation expenses for setting up a foreign entity can be remitted by an AD bank up to a maximum of A. USD 50,000 per foreign entity, B. USD 1 lakh per foreign entity, C. USD 2 lakh 50,000 per foreign entity, D. USD 5 lakh per foreign entity. The answer is option B. USD 1 lakh per foreign entity. Under ODI reporting, an APR annual performance report is required to be submitted for each foreign entity. When is the APR due? Assuming the accounting year of the foreign entity ends on December 31st. A. By March 31st of the year following the accounting year end. B. By June 30th of the year following the accounting year end. C. By September 30th of the year following the accounting year end. D. By December 31st of the year following the accounting year end, that is the next December 31st. The answer is option D, by December 31st of the year following the accounting year end, that is the next December 31st. An Indian entity delays the reporting form of Form ODI-1 which captures flows. The amount involved is rupees 50 lakhs and the delay is 2 years. What is the late submission fee payable? Option A, rupees 7,500 only, flat fee for Form ODI-1. B, rupees 7,500 plus 0.025% into 50 lakh into 2, which is equal to rupees 7,500 plus rupees 25,000, which is equal to rupees 32,500. C, rupees 7,500 plus 0.025% into 50 lakh into 2, which is equal to 7,500 plus rupees 25,000, which is equal to rupees 32,500, subject to maximum of 100% of amount. B, rupees 50 lakh thousand, 100% of the amount since delay exceeds 1 year. The answer is option C, rupees 7,500 plus 0.025% into 50 lakh into 2, which is equal to rupees 7,500 plus rupees 25,000 plus, which is equal to rupees 32,500, subject to maximum of 100% of amount. Which of the following is correctly classified as a strategic sector under the ODI framework? Option A, pharmaceutical manufacturing. B, real estate development of special economic zones. C, submarine cable system. D, textile exports from export processing zones. The answer is option C, submarine cable system. Under FEMA ODI regulations, dividends received in a foreign currency account maintained abroad by the Indian entity must be repatriated to India within A, 15 days from the date of credit, B, 30 days from the date of credit, C, 60 days from the date of credit, D, 90 days from the date of credit. The answer is option B, 30 days from the date of credit. Under the ECB framework, what is the minimum average maturity period MAMP for ECB raised by a manufacturing company up to USD 50 million per financial year? A, 3 years, B, 5 years, C, 1 year, D, 7 years. The answer is option C, 1 year. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.